Hi, Lawrence. Happy to
How
have
are
you
you?
here. I'm good, thanks. And you?
Good. Nice to be with you.
Okay, great. Let's maybe wait also for Francesco. First thing, also, you prefer Lawrence or Larry?
Larry.
How
Yeah,
you
Larry
prefer
is
to be
fine.
called? Larry, okay, great. Meanwhile, I say hello to all the listeners. They will join more and more later on. I see also Francesco. Hi, Francesco.
Nice to.
Hey, Francesco, how are you, man?
I'm fine. Okay. It's the second time talking to you.
Yeah,
Very
it's going to be a regular occurrence.
Yes, it was. Last time it was during the ETFs discussion. I remember we also discussed about economics. This time we will focus more on macroeconomics.
Okay.
Great. We are all here. So we'll say welcome all to the 5th episode of our X podcast, Store of Bitcoin as a store of value. And we are very happy to have Larry Lepard as a special guest. With him, we will deep dive on macroeconomics and on Bitcoin as a store of value. And Larry, we were thinking with Francesco to have 5 main points. Firstly, we can discuss about the current economical situation. Second, also the outlook of the economical situation, what we think will happen in the next 18, 24 months. Then the biggest part of the space I would like to have is the problem with our economical system. You already described in many other podcasts, and people like with your experience and with your knowledge, I think are great to also give the tools to others. What should say to people who don't know so much about the Bitcoin, why we have a problem with our economical system. And the last 2 parts will be why Bitcoin is the solution, and latest Bitcoin outlook 2024 for this cycle and the impact of the ETF. What do you think?
That sounds great. I'm happy to cover all those subjects. I'm not sure I'll add much that people haven't heard other places, but I'll give you my views.
Yes. So let's start with the first part, the current economical situation, where we stand now. And maybe we can also starting describing, I think we are all a bit surprised that after more than 1 year with the interest rate at 5.3%, there has not been, at least not big signs of hard landing or soft landing, and S&P 500 is still went above $5,000.
Yeah.
Can we
Yeah, I'll talk about that. I mean, I'm surprised as well. I thought the S&P would have fallen apart by now. But what happened that we didn't really fully understand is that the government hit the accelerator pedal on spending, and they've just gone crazy. I mean, they're spending at almost at COVID-like levels, and yet we've got relatively full employment and an economy that's it hasn't really collapsed. It has for poorer people, but for the middle class and above, it's they're still hanging in there. And as you can see, the employment numbers, although they're somewhat doctored, there's still jobs available. People who want to work can work. Now they're getting roasted because the cost of everything they buy is going up faster than their wages, and the wages are why the inflation is going to be so sticky. But we can come back to that. But the economy has definitely surprised to the upside, and I think the reason is, you look at what Congress has done. I mean, they recently approved a $1.2 trillion spending package in 48 hours. In one of I have my quarterly reports are up on the web and they're free, and you can look. And the quarter before this one, the March one just came out. They're at ema2.com, which is my website. The December one had a really interesting chart in it that basically showed that spending levels are back to COVID-like levels, and yet we're not in a crisis. And so the government, I think, the Biden administration, in order to prevent themselves from getting voted out, which I don't think is going to work, has just spent like more than ever, like a drunken sailor. And you've had other things go on that couldn't necessarily be anticipated. I mean, they could, but they got worse. The Ukraine war and the Israeli situation. As we all know, they just passed a $90+ billion spending package to aid those countries. So and that money flows into the U.S. economy because it's generally speaking goes to defense contractors who hire people to build weapons that get used in those wars. It goes to a lot of other things too, but that's a big piece of it. And so, it's been a surprise to all of us, I think, that the economy has hung in as long as it has. It also is, I think, a factor that just there's a lot of money out there still sloshing around, and it needs a home. And so it tends to chase performance in these stocks. You've got this whole AI trend, you've got the NVIDIA trend. The typical U.S. investor doesn't really understand what a bear market is because there really hasn't been a bear market, a true bear market of any duration or depth since '08. Every investor who's been in the market since '08, and think about that now, that's almost, 16 years ago, has been trained to buy the dip. Always buy the dip and the market comes back. And there's going to come a time when that's not going to work. You're going to buy the dip and you're going to lose 50 or 60% of your money. But it hasn't happened yet. And, the market is historically extremely expensive, compared to the 2000 metrics and the 1929 metrics. It's right at the same level. So to me, the market is really headed for trouble. And yet, because I think the stocks do represent a claim on businesses which have earnings and which might reprice in the new currency, we saw in other very inflationary economies and hyperinflationary economies, the stock market sometimes does pretty well. And you get into kind of what the Austrians call a crack-up boom, a von Mises crack-up boom, where people are borrowing money and investing in things they think will go up in value. So you've got kind of a confluence of factors that have kept things healthy, but there are cracks in the system, and we're seeing a crack in the 10-year bond market, which is starting to creep back up towards the 5% level. Last time it was at this level in fall of last year, Fed had to come out and say, hey, we're done with the rate hiking cycle, we're going to pivot. Well, okay, nice idea, except that the inflation numbers haven't come down the way they thought they would, and now that pivot is being taken away. And so it's quite complicated, and none of us really know with any certainty what's going to happen. But I go back to the basic principle, which is that you can't expand debt at a rate, and this is my pinned tweet, you can't expand debt at a rate in excess of your growth of the GDP, because ultimately that's a formula for disaster. The GDP is what generates the earnings and income to pay the interest and the principal on the debt. If the debt's growing faster than the GDP is growing, eventually either the debt becomes worthless or you print GDP in order to satisfy the debt in nominal terms, but the value of each currency unit becomes significantly less. And so we're kind of seeing a combination of both things. In the Silicon Valley case, Silicon Valley Bank case, the debt tried to kill that bank. And, if they hadn't broken the Dodd-Frank law, they would have. But, the Federal Reserve, of course, broke the law to save the banking system and bailed out the depositors, which was black letter law. They weren't allowed to do that, but they did it. And so, so you see these things breaking, but then you see them fixing it. And they break and they fix it and they break. And at the end of the day, the reason why I'm so bullish on, sound money assets, gold and Bitcoin, is that, they represent money that the state can't print. And, we know at the end of the day that push comes to shove, the Federal Reserve and the state are going to try to keep the system going, and that to do that, they need to print money. So it's kind of a long-winded answer, but that's kind of the opening to where I see us now. But I have to say, it has surprised me that the market's held together this long, and it just goes to show you that you can never be certain what's going to happen.
I will say that when I saw 1 year ago the yield curve, which was inverted already in a deep way, and nothing was happening, it sounds strange to me. But now nothing happened, right? So maybe when we are talking about the evaluation of a currency, the hyperinflation cycle, some bad things that fortunately we know that they are coming one day. Maybe we have to ask ourselves: is the change? What is the inflection point? The inflection point. When the market structure is going to change that much, that is not going to get back anymore. So where is the threshold? Because I think that if the interest rates are so high and the market so high, they didn't raise anymore, but they didn't lower, right? So but the market didn't account that. They didn't take into account, so it rose. And so maybe it's the first time in history. If this is the first time in history that happens, maybe we have already reached that inflation point, where the interest rates and the action of the Federal Reserve don't count that much anymore. Of course, it will matter when they lower it, but because the root cause is the money printing, in my view. But it doesn't work reverse, which really is the opposite of what Powell just said today, that is not, so you also retweeted, which is not, there isn't a clear correlation between money printing and inflation.
Yeah.
If you would think that this theory and the inflection point as set as the point where the interest rates, the rise of interest rate don't affect the market anymore, maybe we are going to head to deep trouble. And I agree with you, there's going to be a big rally, like always happened in all of the destroyed economies like Venezuela or others, stock markets, which they rose deeply, and then they crash all of a sudden. So I don't know what you think about this view. Could be the failure of interest rate policy as an indicator of the failure of the whole system, in your view?
Well, look, they're searching for a rate of interest which is restrictive, and I think they haven't found it, and they find themselves in a position where they're trapped because a rate of interest with the restrictive, which would be, imply that there's a positive real return on a 10-year bond, which there really isn't today. I mean, inflation is kind of running in the threes and the 10 years in the low fours. So I guess there's a slightly positive. I think if you look at the swaps, it looks like it's a little better for the bondholders. But I think all of us know the inflation numbers are cooked. And I don't think Powell's actually at a restrictive level. And so this is why, restrictive enough level to tame inflation. And this is why he's trapped, because even at today's rates, if he doesn't cut rates, the U.S. federal government is going to have interest expense exiting of 2024 of 1.6 trillion per year. So, that's problematic. That's deeply problematic because it's a big number. Tax receipts are in the mid fours, 4 trillion per year. The defense spending is 900. Social and medical is another, billion trillion five. I mean, we're clearly running a $2 trillion deficit easily, maybe more. And, they're damned if they do and they're damned if they don't. If they do, they raise rates, they create a bigger hole in their budget deficit. They have to sell more bonds. Having to sell more bonds, supply and demand, all things being equal, means rates go up even higher. And so, this is a classic sovereign debt crisis where eventually the cost of servicing your debt gets so high that you can't realistically service it through your bond market, and people are losing faith in your bond market. I mean, if you're looking for the breaking point, the thing that I'm watching, and we're seeing this now in Japan in a small way, not in a small way, in a major way, but off of smaller numbers, is the bond market. When they lose the bond market, then it's all over. I mean, there was a good tweet this morning talked about how Greece, the Greek 10-year was, when they had a debt crisis, in the last 20 years, the Greek 10-year was trading one day at 6%, and then not too far after, once it really became clear they were in deep trouble, the 10-year over there traded at 25%. And I think what could happen here is that everybody in the bond market is still kind of sitting there, hoping that the problem's going to get solved. But I think it's going to become more and more clear to more and more people that the problem's not going to get solved, that the 10-year is going to go through 5, and then it's going to start to approach 6. And at that point in time, they've really got a problem, because, that cost of interest is not something the government can support. And if everyone, I mean, what really the bond market is based on confidence. You buy a bond with the confidence that the monetary issuer is going to be, restrained enough in their issuance that you're going to get back something that, preserves your principal. And I think that whole, we've had 40 years where that was true, or relatively true. And now that's not so true anymore. And I think, the early people have figured it out. I mean, us gold and Bitcoiners have figured it out. And I think what's going on is more of the world is figuring it out. I mean, you're seeing headlines and, talking heads discussing this. I mean, again, my last quarterly report, I mean, there was a headline in the Washington Post that basically said, $100 trillion worth of debt added in 100 days. I'm sorry, $1 trillion worth of debt added in 100 days. Well, 365 days a year, that's 3.65 trillion increase in the national debt burden if that rate continues. And that's 10% growth in the national debt, and the economy is not growing at 10%. So once again, you go back to my original tweet, which is, you cannot grow your debt burden faster than you're growing your underlying productivity and GDP without ultimately having a problem. Now, I emphasize ultimately you can delay the problem for a few years, and they have delayed it for many, many years. This problem's been going on for a while, but it's getting to be more acute. And in my opinion, we are going to have another 2008-like event where, the sovereign debt market says, no, we're not, we're not buying this anymore. And U.S. interest rates blow out like the repo crisis in 2019. And the Federal Reserve has to come back in with QE and maybe yield curve control. And, they're going to approve this ISDA letter and allow the banks to buy the debt. I mean, they're going to do whatever. And they're going to say none of this is money printing, and they're going to say everything's under control. And they're going to try and mask it and pretend that it's all normal. But those of us who understand how these markets work and are very close to it are going to call bullshit. That's not normal. This is what banana republics do. They print money to pay their debts. And once it becomes clear to the entire world, and it's becoming clear, by the way, but I'm talking about, all of the world and all investors, that the United States has turned into a banana republic, then it's all over. I mean, then we're going to have really high inflation and, arguably even hyperinflation, but I don't want to go there. I hope that doesn't happen. But the point is that, it's an inflationary situation. And the other thing that Lynn Alton does a really nice job of pointing out is that you can actually make the argument that higher interest rates are inflationary in the sense that it increases the cost of, one of the reasons why you have inflation is because supply and demand aren't balanced. And so excess demand, not enough new supply, prices go up, right? Well, how do you get new supply? Well, you make CapEx to create facilities that can produce more of something. Fine. Well, if your CapEx suddenly has a capital cost of, a higher capital cost than it did, that makes you less likely to want to invest the money to build the additional supply. So there's an argument that says that higher interest rates are actually inflationary. And so in a certain way they are. But, in terms of, restoring confidence, in the underlying currency, what they need to do is go to where Volcker went, which is a really high inflation rate. And they say, we're not going to bring it down until everything's balanced. And so be it. But the problem is that when Volcker did it, debt to GDP was 30%, and now we're at 120. And so if we took rates to 10%, the entire country would go bankrupt, or most debtors would go bankrupt. So it's a real conundrum, and trying to figure out how it's going to play out is extremely difficult. I mean, there are going to be a lot of zigzags, and sometimes it's going to look highly inflationary, sometimes it's going to look highly deflationary. There are a lot of, debt is fundamentally debt is a deflationary thing because you're borrowing future consumption. You're borrowing money to consume today what somebody would produce in the future. That capital is, you're creating debt capital to do it. And that debt has to be paid back. And when you go to pay the debt back, then you're not consuming. So that's a deflationary thing. And yet, because, a debt collapse would basically lead to a Great Depression, and the Federal Reserve has told us since the helicopter speech by Bernanke in 82 or 2002 that there's no way they're going to allow inflation to happen here because they have a printing press. We almost know that what the playbook is. So the playbook is every time things start to collapse, we're going to print more money. And that's what they've done. They did it, and they do it lots of subtle ways. When I say print more money, there's 10 different levers they can pull on that. One of them is they just issue more short-term money and suck capital out of the reverse repo, funds that they're holding for banks. So, but they all lead. You don't have to get deep into the weeds of the monetary flows and all the inside baseball of, the Fed economics. All you need to know is that over time they print money to cover the debt. And that makes each unit of money worth less. It's like, watering the beer. The beer's not as strong as it used to be.
Yeah, it's like that there is an equilibrium when once it's broken, the farther you broke, of course, the more difficult is to get things in place, and the swings will be wilder and wilder. And to this regard, what you just described, if I'm not wrong, is the theory of Russell of how things will go about in the following years. He said that Japan will be the first one to have this problem, which is already happened, and they will exert an yield curve control, and then there will be a capital flight, but and then a domino effect in his view. But I'm asking, do you think that also the US is relying on the fact that it is the reserve currency, and then therefore if there are going to be problems in Japan or other countries in other currencies, then the capital flight will benefit the US because they will try to move capital there. Is that being taken
Well,
into
yeah,
account?
I mean, the milkshake theory is correct in the sense that, you know, the periphery companies have trouble before the dollar has trouble, and the U.S. has abused the privilege of having the world's reserve currency for, 40 plus years. I mean, the abuse has gotten much larger now. I mean, you can't even store money in our stuff and know that we're not going to confiscate it like we did with the Russian reserve assets, which was just an enormous mistake. But yeah, the periphery countries will have trouble first, and we're seeing that in Japan. We're seeing the yen getting sold hard. We're seeing, they're having to revert to yield curve control and they've been doing yield curve control for a long, long time. But they're going to have problems. I mean, they've got to get to the place where they can pay for yen, or they can pay for oil in yen, or else they're going to go bankrupt. Because if oil's priced in dollars and the yen is sliding rapidly, their oil bill is going to get very large. But they're in a better position than we are for a couple of reasons. One, they're a nation of net savers and they have positive capital balances overseas. We don't. And two, they're a very productive exporting nation that makes a lot of useful shit, and they run a trade surplus, and we don't. So, to compare the U.S. and Japan is not a perfect comparison one to the other. But the fact that they're having trouble and that their fiat currency is sliding is, it's like, yeah, that's a canary. And, it's going to come to all fiat currencies. It may come to the dollar last, but it's coming to all of them. And it's, it's entirely possible, in my view, that the yen is the first currency to hyperinflate. If, I tell you, you don't want to live in a world where the yen hyperinflates, because the dollar is going to hyperinflate too. Because they just, what we're talking about here is a loss. I mean, when you study hyperinflation, what you see is that when everybody knows that they cannot stop printing money and that is part of the national policy, when everybody knows that's common knowledge, you see people rushing to the exits. It's called Gresham's Law. And they'll just, they'll literally, every dollar they get a hold of, or every currency unit they get a hold of, they'll swap it for something the government can't print, because they know it's going to be worth less in the future. And as that process accelerates, monetary velocity explodes, and the price of everything just goes up very, very rapidly. And it's interesting because people from other countries understand this. I mean, the U.S. is the one country that hasn't really had hyperinflation since 1789. And so the average American is totally clueless about all of this. And we haven't even seen, a real crisis since the Great Depression, although the 08 was a pretty big deal. And so it's going to take a while till everybody comes to that conclusion. But I've already reached that conclusion. Probably most of the people on this call have reached that conclusion, and we're very early adopters. And but we're gonna get joined. Wait until gas is $7 or $8, and wait until the deficits are 3 or 4 trillion, and wait until the Fed says, hey, we're going to give the ISDE rule to the banks so they can buy the bonds, and then wait until yield curve control comes in and the Fed balance sheet. I mean, I think in the next iteration, the Fed balance sheet went from 800 to crept up to 3 trillion under Bernanke, and then of course in this iteration it went from 3 to 9. They brought it back to 7, and I think it'll go from 7 to 15 or 20, 25 in the next iteration, which is undoubtedly coming because it's just a mathematical problem. I mean, this is not hard to figure out what's going to happen. You have a very high certainty equivalent on the event, on where this is going to go. What you don't have is the knowledge of whether it's tomorrow or 4 years from now. I mean, it could, I think it's much sooner than 4 years from now, but they're pretty good at kicking the can. I mean, I thought when Silicon Valley Bank failed, I thought that might be the kickoff event. And they were able to put it all, create a new facility, break the law, stuff it all back in the can. Everything's good, and they'll have, I mean, there's no doubt they have contingency plans cooked up for all this. They've got lies they'll tell us. And, I've been told by guys in DC that they're working on a commercial real estate bailout facility. Maybe they are. Makes sense because there's a lot of commercial real estate that's going to damage the regional banks. So, they're going to try like hell to keep things together. That's their job. But those of us who, and they're going to try to gaslight us and tell us that there's no inflation and, all the usual shit. But, our lying eyes tell us what's going on. And more and more of our fellow citizens are picking up on it too. And, eventually the exits, people are going to realize that there's a fire in this theater and they're going to want to get out. And the exits, we know what the exits are, and they're going to get crowded. So I mean, to me, what I watch, the three things I watch for indicators: I watch the bond market very carefully, all durations, and then I watch the price of gold and I watch the price of Bitcoin, because I think those are the three best indicators of confidence in the monetary system.
Thanks, Laura. Thanks, Larry. So many good points. One highlight is on the debt that you said. Actually, also US took, I think, 200 years to reach the first trillion in debt, and now, as you said, it will be 1 trillion every 100 days.
Right.
So it's gradually and then suddenly. And 2 years ago, it was 0.6. It was 600 billion when Bitcoin was in the bear market. Now is 1 trillion. And you said maybe next year could be 1.6 because, as you said, now if we have a high interest rate, also the debt, I think James Lavish said in the next 3 years, we will have 45% of the debt to be renegotiated at the new interest rate. Maybe it will not be 5.3 as it is now, but it will not be 1.2 or 0.5 as it was years ago. So it will the debt will increase the interest in the debt. And also, I think as a human brain, is hard also to really conceptualize how much is 1 trillion. But if we say also the whole defense of US, of the biggest country with the biggest defense, by far the biggest defense of the world is 800 or 900 billion, the interest on the debt is even higher than all what it costs for all defense and military. It sounds really huge.
Yeah, it is,
Increasing.
and it's not even. I mean, it's even a little worse than you described, because I think the average interest rate across all durations on the debt today is in the low threes, like 3.3% is what we're paying on our. We can do it. Whatever divide 1.6 by 34. That's kind of what the interest rate is today. The average interest we're paying, but the debt's maturing and rolling over constantly. And if you go look at the U.S. federal, debt cost structure from, the bills all the way out to the long term, I mean, everything's in the 4s and 5s now. So as we roll over, we've got some of that nice old cheap debt, but it matures, and then we got to go out and issue new stuff to cover it. And the new stuff is 5%. Well, in the 10-year, it's 4.6, but in the shorter stuff, it's 5%. And so the 1.6 isn't the end of the interest cost increase, right? And by the way, I think that, I think the bond market is only going to go one way. I mean, Luke Roman does a great job of analyzing all this and talks about it. And in any financial business or game, you want to figure out who's the sucker at the table, at the card table. And in this particular case, I mean, the sucker at the card table in this game is the bond market. I mean, given the way the U.S. federal government is responding, there's just absolutely no way anyone in the U.S. bond market is going to do well, in my opinion. I mean, unless we have an enormous depression and, interest rates go back to zero. But even then, the accounts might not be such that it's money good. So, I mean, and by the way, I'm not against short-term bonds. I mean, I own, 4-week paper because it pays 5%. But, I would never want to own anything with a duration of more than 6 months, because I think at some point this bond market's going to wake up and go, hey, you're right. We are the sucker and we don't like it. And, sold to you. And so, and the price of the interest rate is just the supply and demand of money. It's the price of money. And so if everybody becomes a seller, guess what? The interest rate's going up. And of course, the Fed can't handle that and the Treasury can't handle that. And so at some point, that's what yield curve control is. They come in and they say, all right, well, fine, we're not going to let that interest rate go up because we know that would kill the economy, so we're going to buy it ourselves. Or, we're going to take the Fed funds rate way down, very, very low, to get monetary velocity going and get people making investments again. And in the process of doing that, they're going to, they're really going to stoke inflation. So, they're trapped, and there's no doubt in my mind that we have very high inflation in our future, and you're seeing this now with the labor costs are quite sticky and high, and understandably so. I mean, everybody's, the cost of doing anything is it's insane. The average person is just getting crushed. I mean, hamburgers cost $25. I mean, it's nuts. You go out to dinner, you can't go out to dinner, at just a low end restaurant for less than an outrageous amount of money. I mean, everything is just insanely expensive, and everyone sees it, knows it, and so rightly so, they're demanding higher wages. And companies aren't necessarily fully making up the difference, but they're making up some of it. And so the whole notion that we're going to return to a 2% inflation environment, that's just a fantasy. That's absolutely, in my view, that's absolutely impossible. It's not going to happen. We're not going to come anything close to that anytime soon. And the Fed probably isn't restrictive enough. But the problem that they know they have is that if they get more restrictive, they're going to blow things up. They're going to blow up the economy. And it's quite a conundrum. I mean, I don't know how it's going to play itself out. I really don't. I mean, I game theory it a lot. I can see a lot of different ways for it to go. I think in part they're political animals. So my gut is they won't raise rates for the rest of the year. They'll probably leave them where they are. They might even cut a little bit. And I'm sure, behind the scenes, they're working on all kinds of programs for when the big one hits. And my sense is the big one is going to hit sometime in the next couple of years. And by big one, I mean, the bond market falls apart and we have another crisis. And at that point in time, think March 2020 COVID, and where, Powell came in and said, he imitated Mario Draghi, the ECB guy out of Italy, and said, whatever it takes, we're going to do whatever it takes. And they just flooded the place with money, trillions of dollars out the door, swap lines to everybody, all kinds of new programs, blah, 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 TARP, stimmy checks, etc. I mean, the tragedy of all that is, I think they sent out, the equivalent of $17,000 per household in the country, but most of it went to all the businesses that some of which didn't need it. And if they didn't fire people, they got it forgiven, and they sent everybody a $900 check. Well, what an insult. You're creating 17,000 per household and you're giving every household 900. Well, where did the balance go? So it's just incredibly fucked up. But it's gonna bring about its own demise, the system, and that's why, when if and when that comes, and it will come, those of us who are aware of sound money and what it means, what it is, have to stand up for that as the replacement, to the existing system.
Do you think will be preferred?
Totally.
Go ahead.
Welcome, Francesco. Okay. So I was saying, I agree that they are trapped, and now it's not they can do X, Y, Z, but the result it can be maybe changed by time. And I also agree, the more we wait, maybe the more acute will be. Also, I remember Lynn Alde was asked if you are in the job of Powell, which would be the first things that you want to do? She say, I will maybe change job because there is no real recept. Because also Austrian School of Economics said every misallocation of money, printing money, create this misallocation, and then the burst will come at one point. It's not that you cannot avoid this burst.
Yeah, I mean,
the more that you wait by
I was asked this from Madeira. I mean, his only good move is to resign. He was an idiot and an egomaniac for taking the second term. He should have gotten out while he could have. The fundamental problem is that, and nobody's got the political courage in this country to do it, but the fundamental problem is the money is broken, and we need to go back to a sound money system. And so, if you had an honest and courageous leader in this country, a Ron Paul type or something, they would come forward and they would say, look, guys, we've got a broken monetary system, and here's why. We strayed away from sound money, and so we need to do a reset. We need to we need to create a new dollar. The new dollar is backed by gold or Bitcoin or some combination of the two, and or oil. And the new dollar is going to be 10 old dollars equals one new dollar. And we're going to have a kind of a semi-debt jubilee / a very high one-time inflation to get all this back under control. and people are going to pay for the sins. We're all going to pay for the sins that we've had, but we're going to go forward. This is the most honorable and equitable way. Everyone will take some pain, but we're going to go forward with a system that's not broken. That's what needs to happen, and that takes political courage and leadership and an understanding of the monetary system, and a willingness to convey that to the people in this country. And as Luke Grumman says, there's a different way of doing it, which is you could take the gold, the 261 million ounces of gold that are owned by the United States, if we still have them, which I don't think we do, but if we did have them, and you could revalue them to a much higher number and say we're going back onto the gold standard, and gold's now $30,000 an ounce. Again, you would have an incredibly high one-time inflation, but on a go-forward basis, you would stop inflation and all this stuff dead in its tracks. So, look, we've sinned, and there's no way to get out of the sin without paying for it. So really, the only question really becomes, what system are you going to use on a go-forward basis? And I would contend that the only system that you can use on a go-forward basis that will not get you back into the same position again is a system based on sound money. Now, there's a lot of pain between here and there. Having said that, though, countries that went through currency collapses, when they did reset to sound money, I mean, look, after World War II, the Japanese yen was worthless. The German Deutschmark was worthless. They lost the war. I mean, in 23, the German Deutschmark was worthless. I mean, and they created a new currency. They backed them with gold. And guess what? People had confidence, and, Japan rebuilt. And, 20 years later, they're sending motorcycles to the U.S. And, 40 years later, they make the best cars in the world. So, sound money will solve the problem that we've got. But, we're going to have to take some pain to get from where we are right now to sound money. And political people, they're not in the pain-taking business. They're in the lying business. And so they're just going to keep lying and kicking the can and trying to make us take the pain of higher inflation. And that's why those of us who understand what's going on are telling them go fuck themselves. We're gonna stand, and we're gonna have currency that they can't print. And then they're turning around and telling us they want us to report it, and they want to stop self-custody, and they want to tax it on. Look, there's good and evil going on here. And the founding documents of this country got thrown out years and years ago. I mean, the Constitution says only gold and silver can be money. Hell, this started a long time ago. I mean, FDR confiscated the gold from the people and then revalued it. He stole money from people and revalued it, and then he stacked the Supreme Court so that they could basically endorse that. I mean, this country has long. I mean, I'm not sure if there was ever a time where we really ran on constitutional principles, but we've certainly drifted very, very, very far away from the founding documents. And so, until we get back to that, we all live in kind of this dystopia, where, they can murder a president, or, lie to us about a disease, or, try and push CBCs down our throat, or all kinds of bad shit. And they're going to continue to try and do that, as much as they can. And, I think the only way we can drain their swamp is just to make their money worthless. And the way we make their money worthless is we try to use it as little as possible, and we support stores of value that they can't debase. So, that's really the message, right?
How do you see the operational of yield control policy? Do you think that the pension funds, as a last resort, could be used to purchase long interest rate bonds, long-term bonds, or other
Oh,
tools?
yeah. Look, no, they're going to try. Financial repression is a long-standing, well-known tool, and they're going to try it. I mean, they're going to, they could tax Bitcoin, they could tax gold, they could determine that we're evil, trying to ruin their great dollar-based monetary system. They could say, hey, you've got all these 401ks that are tax-free. We're going to take away the tax-free status if you don't use them to buy government bonds. There are a million things they could do, to try to prevent our side from winning. But the mathematics of the situation suggests that our side is going to win. That there's no doubt about that. It's just a matter of on what time scale.
Yeah, unfortunately, by night there is the new dollar you were talking about after everything crashes, or maybe also before when they know it's about to crash, could be the CBDC, which is backed by nothing but by dystopian digital certainty in the government about people. What do you think about the CBDC as the new dollar in a
look. Can you hear me?
Yes,
hear me?
yes.
Yeah. Look, I don't know. I don't know how they're going to get anybody to accept the CBDC, but it's obviously what they're going to try and do. I mean, they've given us plenty of clues that that's where they want to go. But I can't imagine. I mean, well, actually, I do know how they're going to get people to accept it. They're going to at the lower rungs of society, when people are desperate and they're out of money and they're starving, and the government comes out with the CBDC and universal basic income, and they get to watch what you spend it on and prevent you from spending on things they don't like and all the above. Yeah, I mean, somebody who's starving and you offer them a CBDC and it allows them to buy food, well, they're going to accept it. But I think the average American, is very aware that, that's a trap, and that, to try and let the government get that much control of your lives is a very bad thing. So I don't see CBDCs working, and I think the time scale here is the stuff is happening faster. As Preston says, the contractions are getting quicker. We're gonna have a baby here at some point. So, uh, my personal view is that kind of by early 2030s, this is all going to be over. This monetary system is going to fail or have failed, kind of spectacularly. We're going to have really high inflation, demands for reform, et cetera, et cetera. The pain is just going to be so blatant and so obvious that they can't hide it anymore. And so what's that? It's 24, so that's 6 years. And that kind of fits with fourth turning theory too, in terms of how long it takes a fourth turning to typically play out. They're typically 20 to 30 years long, and so this one kicked off in 08. So 20 years would be 2028. So I mean, maybe we go into the 2030s. Maybe I'm a little early on the saying it's going to happen early 2030. But it's we're building in my view, because of what they're doing. I mean, we're building toward a conclusion. The sending out money, the stimmy checks, the program where they guaranteed, they sent money to all the businesses. I mean, they pretty much indicated, we can kind of see what their plans are. The next time the economy collapses, they're going to say, okay, exigent circumstances, we got to print a ton of money and send it out to people. And they will, to keep the economy running, and it will continue to run. But guess what? We're going to have $12 gasoline and, $50 a pound hamburger. I mean, it's the only way out. It's just, continued massive inflation. And they're stealing from, pensioners and savers and anyone who has dollar denominated assets that hasn't figured out how to protect themselves from the built-in inflation that their system generates.
Yeah, and of course the universal basic income will be a thing because of the AI and the loss of jobs. So this trend will be also accelerated. Okay, maybe you want to talk about Bitcoin in this scenario, Alessandro?
Another question I had was, then we move on Bitcoin. On the inflation. So I think one of the problem is that it's called just inflation. If it was called as it is, like a tax on the low class, no one would say we should tax the low class to stimulate the economy. But now people are saying we need inflation to stimulate the economy. We see that inflation is hitting much more on the low class than middle or upper class. Also, as you said, I think I agree that they are kind of trapped because they cannot increase even more otherwise they create a recession, the interest rate. But as you said, interest rate now, increasing interest rate now is not so deflationary as it was in the 70s. In the 70s, it was more fractional reserve banking and low debt. Now we have much more debt, so increasing the interest rate increase also the debt. So it's a kind of both signals, deflationary and inflationary.
Sure.
I think that at one point they will say 2% target is not anymore the target because we cannot reach anymore, and maybe they will change the target in the next years. What do you think?
I think that's right.
Possible?
I mean, you've already seen some of them talk about that, and they'll probably say, hey, I mean, they've always kind of said better to have a healthy economy with inflation than to have a depression. I mean, they've said that kind of constantly, and so we know that they will probably let inflation run hot. And we all know inflation is running hotter than it is. In the earlier part of your statement, though, you touched on something that's very important to understand. The entire Keynesian model is a lie, and it's wrong. The notion that you need inflation to generate demand and to have animal spirits to keep the economy running, that's just all a crock of shit. I mean, it's just complete and utter horseshit that you've got to have inflation to generate demand. Demand occurs because people need shit. And, the whole notion that government should get in the middle of the equation and should stimulate demand at certain periods of time by making money cheap or issuing money or whatever. I mean, that's like, just saying it, yeah, you should have a drug dealer because it really feels great when they give you heroin and you get a really incredibly high for a while. But guess what? Then you crash. And so, the notion, the Keynesian notion of growth is good at any cost is completely and utterly wrong. What we really care about, and this is why Booth's book is so brilliant, is we really care about deflation, and deflation has gotten a very bad name, Bernanke and others, and because we had a deflation in the Great Depression, which really was the function of a bursting bubble. It wasn't a function of poor Federal Reserve policy. I mean, well, it was. The Federal Reserve policy led to the bubble in the first place, but the point is the deflation we had wasn't because the Fed didn't print enough. The deflation we had was because the bubble had fucking burst, and so. But the point is you never let the bubble get started because you never monkey with the interest rates. You never do all the stuff the Fed did to finance World War I, et cetera. So, but the point is that Keynesianism is wrong, just plain wrong. And if you have a sound money standard, the natural condition would be that everything gets cheaper over time because there's increased productivity and we get more and more ingenious about how we do things. And that's what you want. And so what you'd like is actually stable prices where prices that are falling over time, the way they do in technology. And that's what would happen for everything if we weren't messing with, the monetary system. And so when you have a debt-based monetary system where money enters the system as a result of growth of debt, you got these two forces, clashing with one another, the natural deflation that comes from human productivity, and then the need for a continually growing, top line number because you've got to support the debt. And the two, I mean, it's just those two opposing forces are destined to crash upon each other, which is why I've said, the Fed is always trying to walk a tight line between massive deflation and massive inflation. And if they, and it's hard, if not impossible for them to walk that line because they're trying to set the price of the most important thing of money, important thing in the world, which is money or capital. And so as a result of that, they're like the Politburo trying to set the price of grain. I mean, they don't know what the right price is. I mean, it's amazing to me. Even Powell has said, he's made so many statements that kind of basically indicate he admits he doesn't know what the fuck he's doing. And I agree, he doesn't, and none of the Fed do. I mean, they got 30,000 economists. They don't know what the fuck they're doing, and so they should just plain get out of that business. We don't need a bunch of people setting a price. The free market should set the price of money. The price of money should be the intersection point between what savers who have money are willing to lend it out at, and what borrowers who need money are willing to pay for it. And so it's all a function of savings supply and savings demand. And the minute you get a Federal Reserve in there and they start just artificially fucking around with rates, I mean, part of the reason why this thing's so out of control and so messed up right now is because they did something that was just incredibly stupid and really, kind of uncapitalistic and uneconomic, which is they set the interest rates at zero from 2008 to 2015. So for 7 years, basically the cost of capital was zero. Money was free. And they did that to try and make up for the bubble that had burst as a result of the housing bubble. So, but the distortions created by that were enormous, just absolutely enormous. And so, I mean, as I've often said, what we've got is these guys are driving a clown car on an icy road, and on one guardrail's deflation, the other guardrail's inflation. They're just bouncing off the guardrails because they don't know what the fuck they're doing. And the right answer is for them to just get out of the money pricing business, and let the free market set the price of money. But of course, nobody really knows that, or very few people know that. So that's my rant on the Fed. Somebody tweeted earlier today that I think it was Rudy Havenstein said that people who criticize the Fed are going to go to jail. I'm definitely going to jail. There's no doubt.
I see at this point it's entirely a game of confidence. I mean, if they can make it pass the message 4% is okay, inflation rate is okay, then everything can be told to them, except that maybe when we reach double digit, it will be more and more difficult. At this point, we have to learn from the communist regimes, where are people actually believing their leaders or faking that to not to risk. I think the majority, there's 50-50, but they are not all stupid. I don't think they can dupe them over and over again. If they can do it once, they say 4% is needed, then the next time people won't believe them anymore. That's what I think.
Yeah, well, I mean, look, the other thing that is going on in the background is people are losing confidence in the Fed. I mean, and you're seeing that. I mean, and big name people. I mean, it's not. And this is why, by the way, this is why gold is at a record high, and this is why Bitcoin bounced up against its record high and will break through it on its next run. You know, because people, what I'm describing, what everybody on this call is aware of, what we all see, you know, that's getting into the Overton window of everybody else. I mean, they're not just watching, you know, basketball playoffs and hockey playoffs. I mean, people are, you know, this inflation was bad, still is bad. A lot of people are really hurting. And I think more and more people are becoming aware that the reason they're hurting is because these monetary policies are just out of control. And so, you know, our job is to spread the word, because if we can get people out of the basic business of, you know, the money setting, setting the price of money business, that's what we want to have happen.
I think also one of the problem is on educating people. Firstly, barely no one knows about the history of money, or what is make an asset good money. Me myself as well. Studied engineering, work in big companies. Before I studied Bitcoin, I was kind of embarrassed to, after I studied Bitcoin, how little knowledge I had on history of money and how the system works, because most of the people, we live at least the biggest part of our life after 1971. So we had only this system and we don't question this system. I see now much more attention on inflation. Like I think in 2019-20, when I was starting to learn about Bitcoin, inflation, if you talk around, inflation was 1 or 2%, mostly was, we need to stimulate the economy, inflation is good. Now there are many more people pay attention on that inflation is not good, but from there to say is the monetary system that is broken, and for this is, I think, a way to go.
Yeah, I think that's right. I mean, it's very clear more people are becoming aware of it, and you know, and they're becoming aware as a result of the pain. And sadly, I mean, I talk about all the political problems. I mean, and they're huge, but you know, trust me, when the issue gets to be big enough, and there's widespread pain, then that's when the problems will get solved, because leaders will emerge and they'll say, hey, look, this is what happened, this is why it's wrong, and this is what we're going to do so we don't run into this problem again. At least that's my hope and my belief.
I see. So maybe now it's time to ask the question of the night. I mean, where is Bitcoin in this scenario? Where it was in the last 10 years? Where it is going to be?
Yeah, sure. I'm happy to go there. I mean, you know, just as a prelude, I came from the gold world. I've been a sound money person for 30 years, long before Bitcoin was formed, and so I'm very familiar with the problem. When Bitcoin came along, I was a little bit slow to adopt. I bought some in 2013, but I wasn't really all the way in, and I'll tell you why. You know, us gold guys, we had seen there were a lot of attempts pre-Bitcoin. If you go look at the etymology of it, there were 4 or 5 companies, you know, Bcash and eCash, and you know, there were other people who tried to do digital money. It never worked. You know, the double spend problem, the security, centralized servers. There are all kinds of different issues that, you know, prevented it from being an operable system. And so when Bitcoin came along, you know, my mind immediately jumped to oh yeah, that's a nice idea, but it won't work, because I had seen 5 or 6 of them that hadn't worked. And of course, over time, I came to realize I was wrong about that. But you know, I didn't, unlike Max Kaiser, who kind of immediately got it and jumped in with both feet, and I wish I had. You know, I didn't really at first understand it, but once I came to understand how it was constructed, I saw more data points, I saw the price going up, etc. then I realized that what they really had created was digital scarcity, legitimate digital scarcity that was verifiable, provable, defensible, and wasn't going to change. And at that point in time, it became obvious to me that, this really is digital gold. And so, both gold and Bitcoin will benefit from a collapse of fiat currencies, which I think is inevitable over time. The question is what time. But I think Bitcoin will benefit more because it's got properties that make it superior to gold. It's easier to verify, easier to move, etc. And so there's an adoption curve going on. I mean, gold's been around 5,000 plus years. Everyone knows what gold is. It's great. But, there's nobody who doesn't know what gold is that's going to learn about it and buy it. Whereas there are a lot of people who really don't know what Bitcoin is, don't fully understand it, and they're going to come to buy it over time, but they're not there yet. And so as a result of that, I think the Bitcoin performance is going to continue to absolutely crush performance of gold. And so, if you can stand the volatility, of the two, I think Bitcoin's a much better choice. Now, some people can't stand the volatility, particularly if they're much older and they don't want to have big drawdowns. And so I think the way that one deals with that is you just don't allocate as much. I mean, anyone can allocate 1% or 5% of their assets in something, and even if it's volatile, that's not going to wreck them if it goes down a bit. So, and I honestly believe it's going to go up, 10x and then 10x again from here. I mean, these coins are 60,000, 60-something thousand today. They're going to be, 600,000, and then they're going to be 6 million. Now that's, probably a 15-year time window, but, I can wait. And, particularly if you're on the younger side, I mean, this is, there are very few assets that have the asymmetry that this one has. And that, I mean, it has the beauty of, I mean, it's like, I compared it in one speech I gave to investing in Microsoft or investing in a lot of, other companies that became very big compounded over long periods of time. The beauty here is that there's not even a management team to screw it up. I mean, it's just kind of an algorithm that's everyone has accepted. And I only see two risks. One, that technically it fails, which I think is very low, given 15 years of history and a bunch of good core developers keeping it sound. And then the second is that everyone loses interest in it. And I think that's very low too, because every year more and more people adopt it. So to me, it's kind of inevitable. So I'm an enormous Bitcoin bull, but I'm still a gold bull too. I mean, gold's going to work. It's just not going to be as good.
I think everyone once have a decent understanding of Bitcoin thinks that it's too late, as you said,
Yeah.
because other people were earlier. But in reality, we are very, very early. There are a lot of discussion how many people adopt Bitcoin, how many addresses. Maybe there are 1 or multiple million. But I think people who really understood Bitcoin, who can discuss at this level of monetary system being broken, advance of civilization, sound money. I don't think we are more than or 100,000 or multiple hundreds of thousands in the world.
Yeah, I don't know.
I
I
don't
think
think
there are probably
we
millions of
are
us,
more.
but there are 8 billion people in the world. So it's, in
Okay.
terms of percentage, I mean, another set of numbers, a couple of numbers I like to look at. One, there are 54 million millionaires in the world, reportedly. 21 million Bitcoin, assuming, and that's not even counting the ones that are lost. But let's say they're all 21 will be there someday. So it means every millionaire in the world could only have one half of one coin. So, if you have a half of a coin, you're fundamentally, in my view, equivalent to being a millionaire. The other thing that I look at a lot, and it's an interesting, there's some good charts on it, is just how big the other assets in the world are. I mean, gold is about 14 trillion right now. Stocks are 150 trillion. Bonds are 150 trillion. I mean, Bitcoin is less than $1 trillion in total market cap. And I think as time goes by, those other asset classes, people are going to come to realize that, particularly bonds, people are going to come to realize that, what, this isn't working. I mean, I'm getting this 4% interest rate and inflation's running at 6%. I'm losing money in this thing. Why am I here? And so they're gonna leave and they're gonna buy an asset that they think will hold value, against hold value against the inflation debasement that's taking place. So, and there are other choices. I mean, they could buy stocks, they could buy real estate, they could buy gold, or they could buy Bitcoin. I think of those four choices, I think Bitcoin is going to have the best performance by far. So.
Yeah, if I have to recall the price history, price action of Bitcoin, the only problem with that is that all happened after the crisis. So with the very low interest rate. So that should make us to reflect, to dig a bit deeper, because it wasn't tested in a very doomsday scenario yet. And how can we address that problem? Is that we have to, in my opinion, distinguish between the long-term effectiveness of Bitcoin as an hedge against inflation versus the short-medium term. And luckily, in the last, of course, it's a store of value. I mean, everybody who held for 4 years is all in the green. Everybody's in the green, but when there was COVID, it crashed in sync. And but anyway, what matters is that now the asset, because before it was correlated to the Nasdaq, was treated as a tech stock because the traders didn't know what it actually was. But now with the with the announcement of the ETFs and also in the wake of them, we have observed a deeper and deeper decorrelation, which is what matters the most to make it true, and also a more and more prominent edge against inflation. Do you see? Do you watch that proper feature of Bitcoin? Do you think that the correlation is widening, therefore it's making what is actually is to the eyes of trader? And how do you see this properties of Bitcoin?
Well, yeah. So, first of all, I think the ETF is an enormously positive thing, and has brought a lot of new money into the space. Will continue to bring new money into the space. I think, sadly, some of the ETF buyers they're not hodlers the way we all are, and so they're renting it and they get a gain and they take the gain, and that's a mistake, but they're doing it and that's fine. So again, it's going to continue its volatility. I think you alluded to its correlation to tech stocks. I mean, look, it's one of the most liquid, aggressive, high performing financial assets in the world, and so it's going to be very sensitive to kind of liquidity, and it's kind of the canary in the coal mine, I think, for how much liquidity is there in the system. And in fact, the fact that its price is soft right now, I'm looking at that and thinking to myself, you know what, that's not good for stocks because Bitcoin is kind of the leading liquidity indicator, and it's soft off its high. Maybe the stock market's about to roll over, and the stock market kind of looks like it's starting to. So, there's certainly a correlation because there's hot money chases both of them. But to me, ultimately, it's going to become a risk-off asset as it gets much more widely distributed. It still looks risk-on just because it's so small relative to the other things. And so when people come after it, that's why it goes so hard. I mean, the first quarter was up 66%, which is that's insane. I mean, that's a bunch of good years for an average stock, and that was one quarter. And then of course people get disappointed because, well, now it's down 20% from its high. Well, yeah, but it was up 66% in a quarter. I mean, it's compounded, since inception. It's just insane how well this thing has done. So, you got to, the volatility is the volatility. And those of us who've been in it for a long time are very used to it. And, we tend to, if we have capital, we tend to kind of hold it aside for the pullbacks, use those as buying opportunities. And, I never really sell, but I suppose there could be a high enough price where I might let a little bit go, but it's a lot higher than where we are today. And so it's, yeah, the problem I think is for most people is they just don't understand it. They haven't taken the time to do the work because, I'm sure pretty much everybody on this call, I'm sure, has taken the time to do the work, and you get it. And it's so obvious. And so your conviction gets to be very, very large. But to somebody who's casually looking at it and hasn't really thought it through at a first principles layer, yeah, it might just look like a shiny object that goes up in value and they're buying it for a number go up. But, then they get a big drawdown and they freak out and they sell it. And sometimes number go up and they buy it and chase it, which isn't always the smart thing to do either. I mean, it's, I kind of like bear markets because they're a good time to buy. And when everybody's all bulled up about it and it's going to the moon, I'm like, oh, here we go. We're gonna have a setback. So, but it's like any other risk asset. Human emotions drive it higher, but we're seeing higher highs and higher lows, and and all these numbers we alluded to earlier. I mean, we're just so very early. I mean, I think having a whole coin is going to be a big fucking deal. And they're going to be. I mean, I know when I paid 300 for my first ones, I'm looking at Max Kaiser paying $2. I'm thinking, geez, I'm an idiot. I really paid too much. But I wish I'd bought more at 300, and I bought some at 17 and 2017, and I felt like an idiot when that came back down. But I bought some more and averaged down, and I mean, I think there'll be some day somebody says, "Holy shit, you bought these things for less than $1 million a coin." They're $4 million. You paid what? You paid 60,000 for one of these things? I mean, I know that's how I feel about Max Kaiser. I sat and talked to Max Kaiser in El Salvador, and he said, "Look, at $2, I thought I was overpaying because Trace Meyer was buying them for 50 cents." So everybody has kind of you can't fixate on the price when you buy it. It's not the price you pay; it's your time in the asset. Because once you understand what the asset's going to do, it's Saylor's phrase, it's going up forever, Laura. And your kids, if you buy some coins and hang on to them, and someday they become worth $5 million a coin, which I think is entirely doable within our kids' lifetime, they're going to be really glad you did that, and you're going to be really glad you did that. And so, to me, it's different. It's hard to think in those terms because that's not how most investors think. Most investors think, I want to buy something, I want to have it go up a lot, and then it's no good. Then I want to sell it before it goes back down. That's a more common investment thought process. And frankly, in terms of businesses and cycles and a lot of things, that's not an entirely stupid thought process. I mean, industries start, they grow, they get mature, they get overly competitive, and then it is time to move on. But in this particular case, since you're talking about a base layer of money, and since we're talking about the first and only commodity that can't be increased, supply cannot be increased with higher price, the price really is going to go up forever. And so, it's a multi-generational asset that you want to have as much of as you can, knowing that no matter what price you pay, in 10, 20, 30 years, it'll be higher, much higher. So that's kind of how I see it.
So long-term mindset more valuable than measuring the correlation, because even if it crashes a bit, because most people didn't get it, it will go up again and in multiples. So it will serve as an edge against inflation ultimately.
Right.
Thanks again also for all these topics on Bitcoin. I double down on volatility. First, from asset perspective, it's a lack of education. People don't get the volatility because for an asset to go from zero, from an email sent from Satoshi Nakamoto to the cyberpunker group to become global reserve currency, for sure there will be volatility. It will be up and down. It will not be going straight up. And second, I think now, for sure, everyone should go maybe in the first cycle. Me also, I bought the first time in 2017 and 2018. I sold because I didn't study enough. I think the same for many other people. But now the amount of Bitcoiners or people who are advocating Bitcoin, explaining Bitcoin is much higher. And one of the simple rules that we say is if whatever you buy, hold for 4 years. If you hold for less, it's at your own risk. And if you lose money, it's not because of Bitcoin, because it's like complaining a dog is barking. It's because you didn't hold for 4 years. I show here in one of the comments the simple moving average of the last 200 weeks that is similar to circa 4 years, and is a line that is going up, so a great store of value. I think one of the problem is we overestimate. I mean, for the new people who new joiners, referring to the ETF now, who had the outflow of 500 million yesterday, we overestimate our capacities sometimes. Probably these people who bought, they said they heard holding for 4 years to be sure or almost sure to make profit. But then when it crashed 20 or 30% or 15% in one day, 10% in one day or 15% in 2 days, thinking to hold is a different thing. And many, they were not able, unfortunately for them. But they will learn. They will buy maybe back at 100, 120. And it's now it's, I think it's sad for people who selling, because from my opinion, it will be one of the last chance for upper middle class family living in the West Country to own one Bitcoin. Once it goes to 100, 120, 150, they will not have enough, not mean wealth, but they will not allocate so much wealth to Bitcoin to own one Bitcoin.
I think that's right. I think it's absolutely right. I mean, yeah, well said.
Yeah, finding the sweet spot is as important as having a long-term view. Both conditions are vital to be successful in Bitcoin investing, I believe. But that's something we under people here talk about, but the majority need some education. Unfortunately, it's not easy.
No, I think, yes, it's not only education. I also came to the conclusion that every person need a certain level also of price. Because I was saying same things of people where Bitcoin was a 30 or 40,000 and they were not receptive at all. Now that we have the ETFs, that there was a legitimization of the asset plus 65, 70K. So now they're listening to the same thing that they were not listening at 40. So now the same people who are now still against, maybe they need a price of 100, of 120 or 200. But at one point, they will capitulate, I think. And on this, I would like to ask Larry, we discussed about the gradually and then suddenly also for the debt. Do you think there will be a similar case for Bitcoin, like at one point where the world will say, okay, this is should be in every balanced portfolio. We need everyone having 2-3%, let's say, or 5%. That is already huge for Bitcoin that has 1.33 million market cap. Where
I do.
From this point,
Yeah,
maybe the cycle will not be playing anymore.
Yeah, I do. I mean, I think we're going to continue to have waves of adoption and waves of price movement, just as we have in the past. And so, I mean, this is the ETF opens up a huge new category of money that can buy it easily. And so they will. And so, I mean, I think in this wave we go up to, I don't know, 200, 250, 300. It's a big number. It's more than 150 in my opinion. And at the end of that, there'll be a lot of craziness, and everyone will be convinced it's going to 1 million. And some people will be using leverage, and there'll be some weak hands and some tourists who got on at the end, and then it'll crash again. Not, maybe not as far as the last couple of crashes, but it'll definitely come back in. As people try and take profits on their gains. And but you'll now have, with each of these runs, you get a larger, bigger contingent of people who are what I just call hodlers. That have coins and they're not selling them. They're going to give them to their kids. They're not, they're valuable, and they're going to keep getting more and more valuable. So, yeah, it's to me, it's like a ratchet. It just keeps getting, tighter and tighter, and you really can't go backwards. But, there will be swings for sure. Rips up and then corrections.
I think one of the reasons why I think maybe we will have less correction, but later on, not maybe next 12 or 24 months. Once we have really pension funds, insurance funds, mutual funds for under 1K, these are kind of investment that maybe now takes time to flow into Bitcoin. That's why we have mostly Bitcoin and ETF purchases from retailers. But once they decide, it's not that they take it back. Like a guy who is 35 years old and is putting Bitcoin in for 1K, or an insurance funds that decide to recommend people to put 1% of their allocation in Bitcoin. It's not that there is a downtrend. They press the button selling. So likely there will always be traders, people with leverage, but there will be less than, I assume, will be less in percentage.
I totally agree.
Versus the hodlers.
Yeah, I totally agree.
And on the price, in my opinion, I think 170 could be a good trigger for the phase between gradually and suddenly, because at 170 we will have a market cap of 3.4 trillion, and this is it will become the second asset of the world, so more than Apple, Saudi Aramco, Google, and so Alphabet. At this point, putting in the position of a person who is against Bitcoin, hostile, I think to justify to be against Bitcoin, it will be really, really hard. If it becomes is a tulip, is a bubble, no intrinsic value, used by criminals, it will be also really hard to. I guess people made career going against Bitcoin. You can kind of risk the career if you go really against Bitcoin once it is a second asset of the world.
I think that's true. I mean, I think the thing that I haven't really talked about, and I don't know if it's going to happen, but it could, is, if we get kind of blatant fiat failure, which is to say, the bond market implodes, and the Fed comes in with YCC, and the economy is really hurting, and they obviously lose control of the existing monetary system, kind of the way they did in 2008, and kind of the way they, in a small way, did in March of 2020 or of 23. But if we really get widespread fiat failure, I mean, you could see kind of hyper Bitcoinization getting triggered, where there's just tons and tons of demand for it, and it doesn't just go to 100. I mean, this is the Samson Mao argument. It doesn't just go to a couple hundred; it goes to 1 million, or more. And by the way, that in and of itself triggers a lot of emotions, and a lot of people who aren't waking up to it are kind of like, "Holy shit, what's going on here?" And at some point, it could risk kind of run away. And I mean, and there is only a fixed supply of it. So, I'm not saying that's going to happen, but I think more than any other asset ever in history, I think it could happen because of the way this thing's constructed. I mean, we've seen assets do something similar to that, the Hunt brothers cornering silver, but there was always silver production, and they changed the rules and screwed the Hunts. But in this particular case, the fact that there's a fixed issuance schedule and the fact that there's a hard cap, we've never really seen a financial asset like that ever. And so I'm not sure we can take all the financial lessons of the past about how to value things and how to look at outcomes and potential outcomes, and say, hey, that's a good template for what we're talking about here. Because what we're talking about here is something new and different that's never existed before. I mean, a perfect example, I use this comparison in another call. So, Gutenberg invented the printing press, right? And before the printing press was invented, only monks could read. The average person wasn't literate, because they couldn't get into whole books and they couldn't read. And so, we went to churches so that the monks could interpret the Latin scripture for you, and they were the learned people, and blah, blah, blah. Well, the printing press got invented, and suddenly they could print things, and suddenly it wasn't just the monks copying the Bibles. They had tons of Bibles, and then they could translate them into English, and then other people could learn to read English. And then, so when that printing press got invented, I mean, did you have any idea that you were going to have, libraries around the world with thousands of books, and everybody in the world was going to be completely literate, or not everybody, but most everybody in the world was going to be completely literate and able to read them, and that you were in fact going to be able to get on a computer and order a book and from Amazon, it was going to be at your house the next day, or you were going to be able to download it onto your Kindle and start reading it 5 minutes after you. I mean, none of that was foreseeable when the printing press got invented. The printing press changed the rules, and then, obviously over the course of centuries, a lot of things happened. And I guess what I'm trying to point out here is I think this is kind of on that scale in terms of what this technological development is. They created, so I don't even know that we are even beginning to fully appreciate and understand what they've got here, which is quote unquote provable digital scarcity, and something that is not a lie because you can prove it digitally, mathematically. I mean, think of the implications for voting, or for personal identities, or for anything. I mean, particularly in an AI world where there are going to be all kinds of fakes and deep fakes and everything else. But if you have your keys and you have your address, and that's going to be quote unquote proof that that's you, or can control you. So, if I think we've got to use our imaginations and extrapolate out here. I mean, this is a really big deal in terms of technological change. And so I think we're going to be shocked. I mean, I saw the IBM PC when it came out in 1980, and I met Steve Ballmer in '83, and he told me that these things were going to be in every house and everyone was going to be running MS-DOS, and his company was going to be $1 billion company and blah 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 blah. And I was kind of like, huh? I mean, I was like, yeah, this is just really a Wang word processor, that's expensive. What makes you think all of that? Do you know what I mean? And Lotus 1-2-3 had just come out, so it was a word processor and it was a spreadsheet, but that was it. And Ballmer was like, no, it's much bigger than that. It's going to be enormous. Everybody's going to need this. And he was right. And so I kind of feel like this is the same kind of thing, or the internet. I mean, I was an investor in the internet in the early days. I remember a lot of people. I remember Krugman saying it's a fax. It's not as important as the fax machine. I was like, no, hang on a second. You mean to tell me I can send an email to anybody in the world and it'll be there in 3 seconds? That's a big fucking deal. You mean to tell me I've got a money that nobody can print, that only I can control, and I can move around in 10 minutes? It's totally immutable. It's totally provable that I have it. That's a big fucking deal. And they can't dilute it like the governments have been doing to us for X thousand years. That's a big fucking deal. So, I think you got to kind of think of it in those terms, and take a much longer term view, such that, what it is on any given day. It's just kind of like, who cares? Who cares what the price is today? I don't care. And there are days when there are days that go by, I don't even look at the price. I don't even care what it is. So, but I know it's going to be a lot higher in 5 years and 10 years. So, can you guys hear me?
Yeah, absolutely. The fundamentals are vital to value correctly the asset. But if I have to use my imagination, I don't want to scare anybody, but they are taking down the extremes of Bitcoin. They're going giants. You say if Bitcoin works very well and people realize and buy and get enlightened, and they're going to give hard times to the US dollars, and the government want to stay there staring at it. So you really need to believe it and to understand that the process is not going to be linear, in my opinion, because it's just better, but cannot be. And okay, there are ETFs, but the majority of coins are in self-custody nowadays, 15 million, 30 million coins. So it really depends how they want to tackle it. When it's going to rise over 200k, 300k, then it's not going to be linear, in my opinion. We see, but I don't like what is happening in the US at the moment with some attorney generals.
Oh yeah,
It's.
Look, there's a lot of bad shit going on, and I mean Elizabeth Warren, and I mean there's a lot of bad shit going on. But you know what? This thing was built to deal with it. I mean, those guys, they're all gonna lose. I mean, that's the thing that's so cool about it, is they're all gonna completely lose. So, I mean, I have to laugh at the other side because they just don't know what they're dealing with here, and the thing's constructed so that they can't win. So it's it's inevitable. And the opportunity exists because a lot of people don't understand it. If everybody understood it, you couldn't buy a coin for $60,000. That's the opportunity, right? And a lot of people are fixating on, well, what did it used to be, therefore I'm paying too much. No, you got to think about where it's going and what it can become, and it's going to be it's going to be a very big and important asset.
Yeah, absolutely. Let's not be scared, but I don't think the 13, 40, 50 million holders are going to send a Bitcoin to a centralized place, and so therefore they're not already scared. I think they are late, and they cannot recoup the time wasted. All this said, I want to tell to the audience that this is a podcast made of episodes. We have a full schedule. We are going to have this Jamie Lavish and other big players. Also, the CEO of Unchained is confirmed for June. So if you follow the host, the co-host profiles, you're going to get notified for the next space. I give the word to Alessandro.
And now with Larry, we started the month of macroeconomics. We also we will have James Levish, Sam Callaghan as well.
And James is great.
So we will deep dive. Yes, I think between you, Greg, Lynn, James, Preston, they are the top of the top for macroeconomics. And I think also Bitcoin will need more and more of people like you educating a mix between Bitcoin and macroeconomics, because the class of 2024, 25, 26 will be more different than the previous class, meaning those who had were more sensible of cyberpunk, freedom. If they had this more sensible feeling, they are already into Bitcoin. Now the next class is more, they will see Bitcoin more an investment at the beginning, and on this we will need a lot of educational
some people see it as
spaces.
some people see it as a speculation. Yep. It is. I mean, it's got that part to it, but it's really so much more than that. It's really, you know what I mean? It's so much more than that.
And for me, yes, we could discuss several hours. It's like a tool for advanced civilization.
Absolutely.
Energy.
Absolutely.
Yes.
Yeah, no, it's the energy efficiency angle there. There's almost a spiritual angle to it. I mean, it's like the first truth engine we've ever really had. I mean, in so many ways, it's really kind of a God-given gift to all of us. And I think that'll become more and more apparent to more people over time.
Or one of the reason is very asymmetric information. Like as you said, many people don't know that much, but for me it's even more. Many people have a completely different, completely wrong opinion. They think they have an opinion, but it's completely wrong. That's why I say the biggest mistake you can do in Bitcoin is having an opinion on Bitcoin before having understood it. Also, due to the FUD from the mainstream media. So, firstly, they need to study, and then they can have an opinion.
Yeah, that's true.
On Bitcoin.
Yeah. Hey guys, I gotta hop off because I've got another one scheduled.
Yes.
But I've really enjoyed being with you. I'd be happy to come back anytime. And I thank everybody for listening. I know I can kind of drone on, but I hope I've given you some useful stuff to chew on. And I would just say to everybody, I mean, just don't sell your Bitcoin. Just hodl on no matter what happens. I mean, the only time I see people get in trouble in this asset is when they trade it. And there's no reason to ever trade this. Just, buy it, hold it, and then if you can, buy more of it. Because, time is your friend. So.
Thanks a lot, Larry. We really appreciate to have you here. And looking forward maybe to meet you somewhere in one of the conferences on Bitcoin if you come to Europe.
Absolutely. I may come to Amsterdam this year, so we'll see. But I was going to come to Prague, but I can't.
Oh, okay.
I can't. But we will definitely meet at some point in the future. But thanks again, everybody. I'm going to hop off now. Okay.
Thanks. It was my pleasure.
Okay.
See you soon.
Thank you.
Okay. Take care. Bye, guys.
Thanks. Bye. I just add one of the point that I forgot to ask Larry to mention that for him Bitcoin is the most asymmetric bet of his more than 30 years experience in Wall Street, and for 30 years he tried to look always for asymmetric bet. So if someone who has more than 30 years experience says something like that, I think it is valuable and it is worth to study. And maybe Francesco, you want to give closing remarks? You already started, but if you want to add something, then I will close.
No, it really is a scholar of Bitcoin, and he's a person who dedicated many years to study the asset, to analyze in deep details, and it's clear from his position that he has no doubt. Like also we don't have, but we still it's not a passive process. We still keep every day studying and questioning it, and the more we do it, the more we see its in value. So that's a food for thought.
Thanks, Francesco. Today is the fifth episode, and I think we can say that in every episode, firstly, they are very educational. We deep dive on special topics. We did with Jeff Booth, with Vijay, with Thomas Farrer, and now today we did with Lawrence. We have all the episodes will be recorded, and they will be in YouTube and in Spotify. Here in the message also that is pinned, I put the podcast Bitcoin as a store of value. If you're interested, if you appreciated this episode, you can subscribe, and circa every week we will have a new episode. We will have Knut Svatholm, that is the author of Everything Divided by 21 Million, then Fred Krueger, James Lavish, and Sam Callahan in May. Plus, we are planning other episode in June, all very educational. We are seeing more and more people, more and more participants. Generally, there are at least 1,000 people, all listeners, or sometimes 1,500. We really appreciate and we really enjoy to discuss with a special guest because it's really great to discuss about Bitcoin and to educate people or those who want to be educated and are interested in Bitcoin to go further and further. Then thank you all to listen to this and see you next week for the next episode. Bye.